because he's been bearish. Greg Branch with Veritas Financial Group. There's a look at your sector heat map, and it was red across the board. Every Dow stock down, every S&P sector in the red, and with sizable declines really across the board too, Greg, which I said is not really surprising to you. You think there's more pain ahead too?
That's right, Scott. You know, last time we spoke, you had another guest on who forecast S&P 500 above 5,000, and I think you'll recall I said that it is far more likely that we see a dip below 4,000 than we see 5,000. All of the macro concerns, I think, are well worn at this point. But at the end of the day, when I look for what I'm seeing for S&P growth at this juncture, I'm at mid-single digits. Put 5% on what we saw last year, that gets us to 215. If you put in 18 times on 215, that gets us at 3875. So, yeah, I am expecting more downside from here as those macro concerns intensify, and as we start to see some of the earnings growth slow and some of the concerns that I haven't even anticipated that are coming out in some of these earnings reports.
Wow. So when Mester tells Sarah, you know, that the Fed at least is in recalibration mode as it relates to interest rates, you still feel like the stock market has a long way to go before it meets the place where the Fed is, 38.75. That's fair value on the S&P to you?
I think so. If we see 5% earnings growth and we're using an 18 times multiple, which I think is appropriate, if, as I think, we're going to see the beginnings of a recession end of this year. I think it's going to come sooner than most think. I think all of the conditions are right for it, quite frankly. And whenever we've seen energy prices double with a tightening Fed and the inflation where it is, it's always led to a recession. And so I don't see any reason why this time will be different at this juncture.
Well, if that's the case, why do you want me to buy financials? I mean, it's not like you're running for the hills in every sector. You like financials, cybersecurity. I can see the obvious reasons for that. Parcel delivery. Right. But why the financials in the kind of environment that you just described?
Right. So there's a couple of unique things with the card processors, right? The thing that we're seeing being restored is those cross-border transactions. We're just getting to the point where we're reaching pre-pandemic levels on those cross-border transactions, which are uniquely profitable for both Visa and MasterCard. But at the end of the day, Scott, it's not that I want to sell and run from everything. What I want to look for is the opportunity. And the opportunities, to me, are in companies that exhibit three things. They exhibit sustainable, strong top-line growth, buttressed by secular tailwinds. They exhibit pricing power, and I think that this quarter is really a referendum on that. And lastly, they exhibit the management acumen and skill to manage the cost side of the business. What that leads to is strong margin integrity, if not gross and operating margin leverage, which gets us those double-digit earnings growth. And in an environment where we're not going, even during a recession,
even during a recession,
yeah. Even during the beginning of a recession, as it comes on, we'll go through some multiple contractions, Scott. But at the end of the day, if you're getting 20% earnings growth, you can take a couple of point hits on the multiple and still get performance if you get 20% earnings growth. And there are some companies that are going to exhibit that.
Okay, I hear you. I mentioned cybersecurity, which frankly seems like I don't need to go into a big explanation because it seems, for obvious reasons that you would like those stocks. Parcel delivery sounds a little more interesting to me because, again, it sounds contrarian for the kind of environment that you just articulated you expect. And those stocks have already been under pressure. The transports have been weak. Why would I want parcel delivery stocks now?
Again, a few unique reasons. Number one, the industry is severely under capacity. And so we can enter a recessionary environment and the demand will come in line to where the supply is. Right now, long-term demand is growing at about 10%. Supply is growing at 8%. That's why you're seeing both in the duopoly commit multi-billions this year to expanding their capacity. And so the industry is so severely under capacity, and they have such strong pricing power that at a certain point when they learn to use it, and obviously UPS is much better at this than FedEx is, I don't believe that these companies should be trading, particularly in a duopoly, at 10 times and 15 times respectively if they're going to give us mid-teens earnings growth.